Hello, and welcome to the monthly market update webinar. My name is Dan White, one of ARK's associate portfolio managers, and I will be moderating today's call. This call was pre-recorded on December 11th, 2025. With that, I will now turn it over to ARK's CEO and CIO, Cathie Wood. Cathie?
All right. Thank you, Dan. Thank you, everyone, for joining us today. Well, as you know, if you listen to In the Know, where I go into a lot of detail about macroeconomics and the markets, we think that we have successfully moved from a rolling recession into more stability. Now, the unemployment rate will continue to go up, and the most concerning statistic out there, I think, is that the unemployment rate for undergraduates who have just graduated is over 10%. And in 1 month, September, the last month for which we have data, it went from 9.3% to 10.2%. So recent graduates probably expecting to have been hired by the end of the summer. That's bad news, of course, especially because these days it takes 25 weeks to find a job on average. That's the duration of unemployment. And we're just trying to encourage anyone who is in that position, of course, to look for jobs. Technology is a net job creator. A lot of people are blaming AI for this problem. And at the margin, that's probably true, especially for entry-level jobs. But we are encouraging people to actually, in that position, to actually, seize the moment and learn as much about AI as possible, learn how to vibe code, and maybe create your own business, because with AI now, we are finding that it is much easier to start businesses than it was when I started ARK in 2014. I had no idea how to start, but ChatGPT, Grok will guide you along the way. So go for it. In terms of inflation, that seems to be the biggest issue right now for the Fed. Nonetheless, it did cut rates again. And we think the unemployment situation is the reason it will continue to cut rates. The unemployment rate is a lagging indicator. It sometimes takes a year for employment to turn around decisively. We don't think it will take that long this time. We do believe we're moving into a productivity-driven boom, ultimately. I think it will look like a boom toward the end of next year, just in time for the midterm elections. So inflation, we think, will not be a problem. That's because productivity is one of the most potent anti-inflationary forces out there. Oil prices are coming down. Rents are coming down, especially because of out-migration, the lower end of the market really getting hit. And that will work into the CPI over the next year. So we think next year could be somewhat of a Goldilocks year. And I think the market is beginning to understand that, because it has weathered two very difficult storms this year: tariff turmoil and the government shutdown, as well as all of the hawkish rhetoric from the Fed after Miran entered, a Trump appointee, and really, I think, forced others to lean in the other direction. So lots of hope for 2026, some of which has been discounted by the market. But if we're right, growth will be much stronger, and importantly, inflation will be much, much lower than it has been with tariffs. And we think at some point it could drop to zero or below zero if we're right on oil continuing to fall and rents falling. With that, Dan, back to you.
Great. Thank you, Cathie. We will now begin the question and answer portion of today's webinar. Questions were received from our clients, distribution partners, and sent to our fund's X and Instagram accounts at ARK_funds. Cathie, I'm going to come back to you on that first question. You outlined a Goldilocks potential outlook for 2026. This first question is kind of trying to get challenge that or poke it. What do you think are the biggest fiscal and monetary risks potentially next year?
I'll start with monetary. I think if we were going to, if the Fed were going to be populated by individuals who believe that growth is inflationary, and there was a lot of dissension on the Fed, I think that would be an issue. I think if Kevin Hassett or Governor Waller, either one of them is at the helm next year, I don't think that will be a problem, though the voters could dissent and cause a lot of uncertainty in the market. I'm already hearing the administration, including Howard Lutnick, very recently on CNBC, talk about growth not being inflationary, and in fact, quite the opposite. In the 80s and 90s, as real GDP growth was picking up, inflation did come down consistently. And I think we're going to see that again as the supply shock associated with COVID and tariffs to some extent, as they pass through the system and we move to the other side of all of that confusion. In terms of fiscal policy, I think if the Trump administration is not enjoying a strong growth environment with inflation and interest rates falling, President Trump could become more of a lame duck sooner than we expect, meaning he'll probably be challenged from a tax policy point of view. We love the tax policies, the effective corporate tax rate coming down to 10%, and individuals enjoying big refunds this year because of no tax on tips, overtime, large parts of Social Security, the doubling of the SALT deduction, and child care tax credits. But if we're in a weak economy, we're going to get a lot of angst around the midterm elections. And, we could see flailing around with, new temporary spending measures, which is the last thing we need. We really need to grow out of the deficit. And I do believe this administration has put in place policies to do just that. But if for some reason we're wrong on that, the deficit will become a problem for the bond markets.
Certainly. And thank you for that, Cathie. Moving now from the macro side of things to the technologies here. Frank, this next one's for you. We could probably spend the entire hour-long recording on this one, as it's our most popular question. So what is your and your team's latest thinking on AI CapEx, revenues, and valuations, just kind of all together?
Sure. I think it's a great and I think it's a very important question. So happy to kind of paint a picture of where we see things right now. And I'm going to cite some data from a market update report from Coatue that came out in October that I think paints the picture well. And we're working on our own updates to these numbers that you'll be able to see in our next Big Ideas report in the new year. But I understand where people in the market are concerned. If you look at CapEx as a percent of GDP, we're reaching levels that are similar to the late 90s during the dot-com boom. And the projections are to go higher. If you look at all the hyperscalers collectively going to spend over $500 billion next year based on current analyst forecasts. But I think the important thing is to look, okay, that looks similar, but what looks different? And if you look at the source of funding for this CapEx, if you look at CapEx as a percentage of cash flow from operations, in 99, 2000, 2001, that peaked for S&P 500 companies at 75%. and now it's at 46%. So the cash flow generation of the businesses, the Mag 6 companies that are spending all of this capex, is much stronger than it was in the late 90s .com era. And then if you look at multiples, I think it's important to look at what the market is pricing the opportunity at. If you look at the NASDAQ 100 companies, the peak in 2000 was 89 times price to earnings. If you look at multiples now, we're at 28 times. So we're nowhere close to bubble territory relative to that late 90s, early 2000s period. And I think you can feel it as well. The market is so scared of a bubble. It's kind of preventing those valuations from escaping and hitting these kind of speculative peaks that they did back then. And I think, outside the public markets, particularly because, we have our ARKVX Venture Fund now. We're focused on where kind of this adoption is happening across both publics and privates. And if you look at the revenue growth of some of these AI native companies, it really is astounding seeing what businesses and consumers are willing to pay for these new AI services that change the way they go about their daily lives as a consumer or transform the way they work day to day in a business. And just to give a few examples, OpenAI is one of the AI labs that is fairly specialized towards the consumer. They have the enterprise products as well, but they've grown their revenue to an estimated 20 billion annual run rate by the end of this year. That's up from 2 billion in 2023. So 10xing that business over 2 years. And to give you a sense, $20 billion run rate revenue would be one of the largest software businesses in the public markets. And they're targeting to be 100 billion plus in the next few years. Anthropic, on the other hand, is growing even more quickly, and they're estimating 9 billion in run rate revenue by the end of this year, up from 1 billion in the beginning of the year. So they're almost 10xing a $1 billion business is quite remarkable. I think both of these companies I would call OpenAI focused on the consumer side, Anthropic focused on kind of horizontal enterprise. But we also see these green shoots of companies that are focusing on a specific vertical or job function in the enterprise. And the most standout category has been the coding assistants there, where you have companies like Cursor and Replit that are also growing very, very quickly. Cursor, for example, is estimated to be doing over $1 billion in revenue, growing over 10x year on year, and Replit over 150 million. And since I mentioned the venture fund, I'll just say that we're very proud to have 3 of those companies that I mentioned all in the portfolio: OpenAI, Anthropic, and Replit.
And I'll add a bit. I want to echo what Frank said about investors being very, very concerned about an AI bubble. I think the reason that's happening is the most seasoned investors in our business probably experienced the tech and telecom bubble. They've been there, done that, and they don't want to get trapped again, and that they're telegraphing that. Those who were in the bubble, though, also should understand how different this is. And I'm going to call out Brad Gerstner from Altimeter, who describes the difference between then and now. Back then, we were pouring money into broadband, dark fiber, it ultimately became. It never lit up, or let's put it this way, it took a decade or more to light that fiber up. Today, we have a shortage of GPUs, and every GPU being produced is in use. Sure, there may be some hoarding, but even that world is moving so quickly, it wouldn't make sense to hoard because of the leapfrogs in technology we're seeing in such short periods of time. Another difference between then and now.
Thank you, Frank and Cathie. And Cathie, I've heard you mention many times when everyone's fearful and kind of concerned about this bubble, you feel a lot more comfort in investing now than when these companies in the market thinks they can do no wrong.
That's right. And just one interesting comparison. I remember very well Amazon in the bubble. Jeff Bezos, who used to do the calls at the time, would proudly say, this opportunity is so big that we're going to increase our investment even more than we told you last quarter, and we are going to lose so much money, and that's good news. And the stock would fly. That would not happen today.
That certainly would not. Thank you, Frank and Cathie. I'm going to stick to the AI side, but go more globally here. So, Frank, Joseph, what is your latest thinking on the AI race between the USA and China?
Yeah, thanks, Dan. I can kick things off on this question. So China made some big moves over the past year with the release of DeepSeek R1 earlier in the year, and they've seen some significant traction on the open weight and low cost model side of things. Raw performance of their frontier model still lags that of leading Western firms by about 6 months, but it's good enough for them to have captured 8 out of 10 of the top open weight models on Artificial Analysis's intelligence index. And by August of this year, they had more than 30% share of API tokens inferenced on OpenRouter's platform as well. However, as much as China is making some big moves over the past year, if they want to maintain this cadence of new model releases, they're going to need much more compute than they can currently access. On a total transistor basis, we estimate TSMC outproduces China's leading semiconductor fab by about 38x, 38-fold. And the chips that are domestically produced in China still lag NVIDIA on total performance and efficiency as well. In addition to that, the chips that they have managed to produce are rumored to have some difficulties in actual usage. For example, Huawei's chips have reportedly caused delays in DeepSeek's R2 model being trained and released. So as a result of that, Western models could erode a lot of the progress that China has made on that low-cost end of the market. In fact, we're already seeing it on that OpenRouter data, where models from XAI and Google have started to regain share that was initially taken this year by China, by Chinese models. So for China to maintain the relevancy that it's enjoyed in 2025, they'll either need to allow their companies to access much higher numbers of NVIDIA's chips now that those bans are being relaxed, or they're going to need to massively increase their domestic capabilities for hardware infrastructure. If they're able to do that, they can maintain competitiveness in that low-cost area. Otherwise, that will likely be eroded by Western models again.
Great. Thank you, Joseph. Moving to now the power side of AI. Daniel, you've done a lot of work on nuclear, and ARK holds several companies with exposure to nuclear power. How do you view the utilities side of that handles the transmission and distribution tied to that nuclear power generation?
Sure. This is a great question, Dan. So I would say in general, utilities have been good businesses historically. However, it's a very heavily regulated arena, particularly for transmission and distribution, as you call out. So, for example, there are caps on the rate of returns allowable for providing transmission services. So all of this to say is that, they tend not to be too innovative. In contrast, when you look at the generation side, the power generation side, as you mentioned, nuclear, we're very interested in nuclear alongside solar and batteries, all of which demonstrated cost decline curves in accordance with Wright's law, meaning for every cumulative doubling of power in the case of solar and nuclear, or energy in the case of batteries, costs have declined by a constant percentage. However, we've said probably several times now that nuclear was derailed in the 70s due to regulatory hurdles. However, when you fast forward to today, the environment is completely changed. There's several tailwinds, be it the regulatory support from executive orders this year, the unprecedented demand from AI hyperscalers for 24/7 power, also the emergence of advanced small modular reactors. And when you combine all of these factors, it really positions nuclear for a massive potential to reignite its cost decline. And then I think lastly, I'd say is that, in the age of AI and data centers, where there's really a race to power the GPUs, as Frank, Joseph, and Cathie and all have mentioned, we think a lot of distributed energy deployment will be behind the meter, meaning it's not necessarily connected to the grid, which would avoid the traditional utilities. And this is largely because of the crazy wait times facing hyperscalers, I think it's around 5 years now if you want to get connected to the grid. And because of this wait time, some of the hyperscalers are getting very creative and innovative. I'm sure a lot of you have read about orbital data centers coming into the news in recent weeks, and needless to say, they wouldn't rely on the service of traditional utility companies. So I think they're kind of the puts and takes of those involved in the transmission and distribution.
Great. Thank you, Daniel, for helping nuance through that. This next question, Tasha, I'm going to come to you. When do you think Tesla's share price may reach that next breakthrough moment? I know we talk about autonomous taxi networks a lot.
Thanks, Dan. In terms of major catalysts for Tesla, we recently saw on X that Elon said that he expects for Tesla to be able to remove the operator in the vehicle in Austin within the next few weeks. So what does this mean? Currently the robotaxi service is autonomous, but there's still someone in the car. They're not in the driver's seat, they're in the passenger seat. But this would be, just the passenger riding in the vehicle. So true autonomy. We do expect there to still be some remote assistance feature. That would be someone outside the car if the car gets into trouble. But this is a major milestone for Tesla in terms of, improving the autonomous technology to scale the robotaxi service. And, I say scale because that's really Tesla's advantage here. Let's look at Waymo. Waymo recently announced that they are in 10 cities now operating. They plan to be in over 20 cities by the end of next year. Except they only have single-digit thousands of vehicles on the road. I think today we just saw there was a recall notice that would suggest there are roughly 3,000 Waymos out there. But I would say single-digit thousands, safe assumption. So compare that to what Tesla is able to do. And of course, it depends on what they prioritize versus customer sales or the robotaxi fleet. But Tesla can produce thousands of cars, in a single day. Last quarter, they produced 500,000 vehicles. So Waymo's really paving the way for the regulatory barriers. And Tesla, while they may come second in a city, we think that they have a key advantage in terms of actually scaling the fleet, which really matters to bring the utilization rate down, which means improving the underlying economics, the cost per mile, ultimately, eventually undercutting today's ride-hail prices, which is what we expect to expand the market for robotaxis far past what we see ride-hail as today. So as you know from our published price target, we think that robotaxis will contribute to the what we believe like the majority of the enterprise value of Tesla by 2029. And we had assumed $2,600 per share of Tesla at that time. That's really driven by robotaxis. So this operator out is really a pivotal moment. Look forward to that. Look forward to more research from us on Optimus and space data centers. But for now, robotaxis.
Thank you, Tasha. And now we're going to change gears a little bit and move over to the multiomics world. This question is, despite the strong performance year to date, when you zoom out, the ARKG fund has struggled over a longer time period. So what potential catalysts might you see drive this continued performance into the next couple of years?
I'll start with an observation that this is if you take out the boom bust around COVID, this is the longest base that I've seen building, meaning trading range for any ETF or stock for that matter, except for some of the multiomic stocks. And, as I've said before, when you're in a trading range for a very long period of time, what's going on is a fierce debate between the bears and the bulls. And it is going to be resolved at some point. And so a long base means either one of the biggest breakouts ever or one of the biggest breakdowns. Now, I think that what was happening in the aftermath of COVID and the supply shock, the inflation, all of the uncertainties that evolved at that time, cash flow became paramount, cash cushion as well. and these companies did not look from a relative point of view very good at all. It was a market where it was just going to be very difficult for them to outperform. What's happened since then is, first of all, in the new administration, deregulation, massive deregulation. We're seeing the elimination for rare diseases of double-blind, placebo-controlled trials because they were impossible to populate except for over a very long period of time. The elimination of much of animal testing. And that's because we can get now at human data much more easily with all of the sequencing technologies and AI and so forth. So we're seeing dramatic deregulation that most people, because they're not focused as much as we are on deregulation and the space, I think they'd be pretty shocked to see. And the other thing that's happening is for the 4 years during the Biden administration, under that FTC, there was no M&A effectively. And this space was hurt disproportionately by the lack of M&A because there was no strategic price discovery. What does that mean? It means we had no idea how valuable larger companies would find the smaller multiomics companies. And the reason that that's important is large pharma is facing, and biotech is facing a $200 to $300 billion revenue hole during the next 5 years as their patents expire and they face revenue cliffs. They're going to need our companies for not only to fill the revenue hole, but also for research and discovery and diagnostic tools, companion diagnostic tools, which are going to collapse the cost for research and discovery. We think from $2.4 billion for just one drug right now, including trial failures, to roughly $600 million. It's going to be very important to their cost structures. And also using blood tests to diagnose disease is going to become a very important space. Diagnosing disease in its earliest months, well before the years we often need to diagnose some diseases. And then curing disease. I think many analysts we've been interested to learn have really not thought that curing disease would be a good business. It is going to be an unbelievably good business, as you can read from some of our reports surfacing about gene editing. So I think we're, in terms of the most profound application of AI, it is healthcare. Autonomous mobility might be the biggest revenue generator during the next 5 to 10 years, but we think healthcare will be the most profound application of AI because of the convergence among AI sequencing technologies and gene editing and other gene therapies. And this is not when, it is now. It is happening now. All three of those are happening now. And I think as more and more analysts begin to do work on some of the names that are not in broad-based benchmarks and therefore not very well covered, they're going to find some gems, and we think we own them in ARKG.
Thank you, Cathie. And to just hammer home that M&A strategic price floor, without it, short sellers just come into the market and hammer these names. I remember just a couple of years ago, Personalis was trading at negative enterprise value. So to just really illuminate how extreme this was the last few years. And I think the M&A talk kind of brings us, it's a good point to transition into this next question. But before we get into it.
Can I just say something on what you just said about Personalis?
Yeah, please.
Yes. So Personalis we've known John West, the founder, since he was CEO at Solexa, a company that Illumina bought and that really unleashed this multiomics revolution in terms of sequencing technology. He understood that the convergence between sequencing and AI, that the most valuable companies would have proprietary data that no one else has. And the validation of that, we held tenaciously to Personalis. The validation of that was Tempus AI, one of our top 10 companies, taking a position in Personalis for exactly that reason.
Yeah, thank you, Cathie. And the talk on the multiomics side, I'm excited to introduce a new member to ARK's team. So we have brought in Ovid, and I'll have him introduce himself just a second as the new multiomics director of research and multiomics portfolio manager. So maybe just before the question, Ovid, if you could give the listeners just a quick background.
Thanks, Dan. Appreciate the introduction and really excited to be joining the ARK team. My background, I'm a scientist by training, always been fascinated at the intersection between biology and technology. I started my career as a management consultant, and the last 6 years at RTW, a life science healthcare focused hedge fund, and happy to be here with the team.
Yes, Ovid's been here for about 4 or 5 weeks now, and we can't wait for you to hear more from him over the coming months. And so with that, Ovid, we'll give you your first question here. What are your thoughts on Abbott Labs' acquisition of Exact Sciences? And do you think this could potentially signal more M&A activity in the genomic space?
Thanks for the question, Dan. As I said, I'm happy to be a part of the ARK team, but just as happy to be a part of the multiomics team at a time when Abbott is signaling their strong interest in the diagnostic space, as evidenced by their acquisition of Exact Sciences. In my mind, the Exact Sciences acquisition is interesting for a few different reasons. Number one, it validates the large market opportunity in the cancer diagnostic space. Number two, it really signals that, as the question asked, there certainly could be more M&A to come. And lastly, last but not least, actually, I think it's good for patients as well. If we start with the market opportunity, many of us have believed for a long time that oncology diagnostics could be a great opportunity, and Abbott willing to invest $21 billion in furtherance of that to take what's traditionally been their point of care or kit-based diagnostics model and really take in a central lab model where they're actually processing patient samples really underscores how attractive and massive that market could be. Abbott's a very diversified company. They have a devices business, consumer business, and diagnostics, and they've chosen to invest in growing their diagnostics franchise. And Exact offers a number of compelling products, both in established brands like Cologuard, a stool-based colorectal cancer screening product, which is already achieving revenues in excess of $2 billion while still growing, around 20%. And they also have their breast cancer treatment selection product, which is a market leader. So those are great growing businesses that Abbott's able to incorporate. But also, and maybe even more exciting, are some of the pipeline or earlier products that Exact has been developing that are going to require Abbott to invest. And so it's noteworthy that Abbott, a large profitable company, is willing to put the OpEx behind both on the sales and R&D side to make these products successful. These include a minimum residual disease testing for finding the recurrence of cancer earlier. It includes blood-based cancer screening as well as liver screening, so moving away from stool for blood, and quite excitingly also a blood-based test for screening for multiple cancers. Could be dozens of cancers detected in a single blood draw. So it speaks to the optimism in the space that these markets can develop despite the technological and in some cases regulatory or reimbursement headwinds that will need to be addressed over the coming quarters and years. Abbott has noted that, for instance, with multi-cancer early detection, these are tests that by statute, Medicare is not able to reimburse. And so the reimbursement and giving patients access to this technology has been a challenge. But we've seen some peers in the market who've actually been able to use cash pay, patients paying out of pocket to get this valuable technology, they've actually been able to make traction and start to scale those businesses. And Abbott's actually confident that that they can do the same with Exact's technology. So I think it's given a boon to the space. You saw many of the peers, the Natera's, Tempus, as Cathie mentioned, Guardant, were up 10 to 20% in the week following the announcement, signaling the positivity and perhaps some short covering that comes in the space when you see this strategic price discovery. On the M&A side, I do think we will see more M&A, and it's actually something that is not foreign to the diagnostics and life science tool space. And so if you take a journey back in time, we can see a couple instances of one acquisition really catalyzing another or even a series of acquisitions in a similar space. If you look in proteomics, back in April 2021, DiaSorin acquired Luminex. 2 years later, Thermo Fisher acquired Olink, and 2 years later, Illumina acquired SomaLogic, three of the major proteomics players finding partners. Similarly, on the single cell space, if we look a little closer in time, in June 2024, Illumina acquired Fluent. In August 25, 10x acquired Scale, and just last month, QIAGEN acquired Parse. So again, one acquisition. This time, we didn't have to wait 2 years each time. It was really over a matter of months. And then coming on to the diagnostic side, in September 2020, Illumina acquired Grail, and just 1 month later, it was actually Exact that acquired Thrive in order to start building their multi-cancer early detection franchise. And so I certainly think it's probably a question of when, not if. And the when is actually now, because just 15 days after Abbott acquired Exact, Natera acquired Foresight Diagnostics, two players in the MRD, the minimum residual disease space, combine their tests and move forward. So that'll be interesting to see. And lastly, just on the patient side, I don't want to forget that this really signals a shift or an emphasis on preventative medicine and an investment in being able to really catch cancer in this case, much earlier when it can be cured and when the prognosis is much better for patients. And so it's great to see further investment into this space. And Abbott has also indicated that they'll be able to use their global footprint to expand Exact's reach internationally, both to emerging and developed markets. So in totality, I think it's positive for the space. It validates the TAM. It signals more consolidation to come. But despite that consolidation can still be good for patients. And it'll be interesting over the coming months to see how Abbott is able to integrate that Exact business, because we know any disruption that might happen in the market space could accrue to the benefit of some of the other players.
Ovid, I'd just like to add a couple of things. We've often said that the inefficiencies in the valuations of companies in the multiomics space have increased the risk of takeovers. And I say increase the risk because, again, after such a long base, of trading ranges, we would prefer, obviously, to keep the stocks in our portfolio so that they can enjoy the breakout. So we shall see on that score. One other plug for our venture fund, Freenome, one of the companies in our fund, had clearly a much better colorectal test, blood-based colorectal test, because Exact licensed it right before this acquisition was announced. So we're very excited for what private companies are doing in this space as well.
Thank you, Cathie. You're mentioning another exciting name in the venture fund. And this next question is all kind of about that fund again. So how does the ARK Venture Fund balance the liquidity with private holdings?
Yes, thank you, Dan. That's a great question. The venture fund is an interval fund. It's a crossover fund. It's a 40 Act fund, so regulated just like our ETFs. And what crossover means is we have include public companies. Our targeted range is 80% private, 20% public. And because it's a crossover fund, when companies actually IPO, they can stay in that fund and provide liquidity going forward. So we have daily inflows in that fund, quarterly redemptions, up to 5% of NAV. And what that means is if a holder of ARKVX wants to sell at the end of a quarter and nobody else wants to sell, and his or her order is less than 5% of the fund, the investor can get all of his or her money back right away. If everyone wants to sell, then the redemptions will be pro rata. So, and of course, the public holdings are an important source of that cash.
Yes, and important to note too, it is daily marked to market at NAV. So investors are getting the fair value, the market value out during any redemption period or when they enter into the fund.
Yeah, and I'll also add something to that, Dan. You know, there are other crossover funds or funds that hold only private companies, and they are exchange traded closed end funds. And what that means is they can sell, depending on supply relative to demand, they can sell at significant premiums to their net asset value. Ours do not. So just to give you an example, there's one fund out there that holds a lot of SpaceX, and it is selling today at roughly 6 times NAV. And even with the doubling in SpaceX, so the NAV has gone up. In fact, the NAV of the fund after this doubling will probably have increased. Well, it will have doubled this year. And yet the price of the fund, if you got into that fund at the beginning of the year, is down 50% because the premium to NAV has been declining, and yet it's still 6-fold of NAV.
Yeah, thank you, Cathie. An important dynamic investors or prospect investors should be aware of as they navigate and become growingly interested in the private markets. And you mentioned another private name, SpaceX. I'm going to come to Sam for our final question here. If the media is not talking about AI and they take a breath, this last week it has been SpaceX. So what, Sam, are your thoughts on the rumored SpaceX IPO?
That's right. They take a breath to talk about SpaceX and SpaceX's plans for AI. So there's been rumors of an IPO in 2026, and Elon has been talking a lot about space-based data centers. So this is very exciting, and as you noted, it is the largest position in our venture fund, though there's no premium there because it is an interval fund. And so this is very exciting. This past year in the spring, Daniel McGuire, myself, Brett, and partnered with Mach 33, we put out an open source SpaceX valuation, and that was pretty much solely based off of launch, Starlink, and direct to sell capabilities. And so this prospect of space-based data centers is a whole new opportunity that we're currently doing work modeling in to see what type of upside this adds to the opportunity. And it's incredibly exciting. You can think about it just very roughly right now. If you wanted to connect to the grid, it would take you probably like 4 or 5 years, and that's for a single project. And then if you were to do it again, you'd wait that time. Maybe you start a few of them at the same time. Maybe you say, the interconnection queue is too long. We're going to build behind the meter. And, Elon was capable of doing that extremely quickly. I think the average time for someone else might be around 1 to 2 years. And that's, again, for a single project. And then the bet that SpaceX is making here is they're going to take the next few years to perfect a reusable starship. And by doing so, they're going to have the ability to launch power into space on demand. So infinite ability to launch power on demand. And so that's a big unlock there. I was just thinking about it in China and other areas of the world. We often say, they have leapfrog technologies, right? Mobile, because they didn't do the landline build out. This is an interesting area where it's like maybe the U.S. is going to leapfrog the rest of the world because our NIMBYism and regulations have made it so hard to build that instead of trying to fight through that, you look for what the future holds and what's actually the next logical evolution. And obviously we're still doing the work, but space-based data centers could be that leapfrog for the West.
Yeah, thank you, Sam. A fun way to end the webinar. That concludes today's. We will briefly show performance statistics that can also be found on ark-funds.com. And so with that, thank you to everyone who listened to today's call. Thank you to the ARK team, and I hope everyone has a happy and safe holiday season with their family and friends.